So for folks that are dialing in, we are all on and we'll be starting shortly. Thanks for joining. Welcome to those who have recently dialed in. We'll be starting at the top of the hour.
Good morning. RRC would like to welcome you to today's event. Please keep in mind that this webinar is for informational purposes only and that CRE credit will not be given for attendance. Feel free to use the chat function to let us know if you're experiencing any technical difficulties. Today's webinar, Implications of COVID-19 Solvency Monitoring, will be presented by Tricia Matson, Dave Heppen, and Becky Shepard. I'm now going to turn the presentation over to Tricia to cover today's objectives. Tricia?
Thanks, Jennifer, and welcome everyone. Thank you so much for joining. We have a lot to cover, so we did decide we were going to start right on time, but I'm sure with everyone's busy schedules these days, we'll still have people beeping in as we go here. Yeah, we're really excited to talk with the group today. There's so much going on and so much that we can say about what's going on in the environment today. So our objectives today, again, there's a lot of things that could be covered on this topic. The things we're really trying to focus on here are helping regulators understand how the COVID-19 situation and the associated economic environment will affect insurers. And also just how you can understand and address the emerging risks from a regulatory perspective as you go through your standard work. So those are the key objectives for today. We're going to do that with some overview background and then also are planning to cover some case studies to kind of bring it alive. So Jennifer, you can move to the next slide. So this next slide shows us the current state with COVID, and I say current, this is from yesterday. As I'm sure you can imagine, this gets updated pretty regularly here. So we had yesterday's statistics on the slide to get us prepared for today, but I did make note of where these statistics were at this morning. This map is updated twice a day. And as of today, there's 803,000 cases in the U.S. and 44,000 U.S. deaths so far, again, based on the reporting that we have. There's also obviously information that's not being reported, and so we'll talk a little bit more about the implications of that as we move through the presentation. So you can go ahead and move to the next slide, Jennifer. So RRC previously hosted a webinar that was more focused on the market impacts, and we're not going to focus as much there today, but because that is such a significant part of this for all types of insurers, we did want to touch on it on this slide. So unlike our prior update, this slide is less focused on what's going on in the market environment and, some of the specific implications in various sectors. What we did here instead is try to compare the current environment and some of the stress points, so to speak, that we have in that current environment with a benchmark adverse scenario. So I'll give a little bit of background for those that may not be familiar with this. The Federal Reserve annually publishes a severely adverse scenario, and it's used by the Fed in their regulation of banks. So it's not directly applicable in the insurance industry. Insurers, of course, look at severe scenarios as well in their capital analysis and their stress testing, and that's something that we all want to hear them talk about in this environment. You know, it's hard to have benchmark data on what the insurers are actually doing with their stress testing because it's not public, but this is a public data point that we can look to sort of say, okay, well, what is severe and how severe are we today? And again, this is point in time. So we're not suggesting in any way that, you know, these are the metrics that should be used to evaluate stress. I mean, a point in time change in the economic environment for most insurers is something that they can withstand because they're in it for the longer haul. But again, just with the goal of seeing, you know, how bad is it, we thought we would compare some of the worst metrics we've seen so far during 2020 from an economic perspective, and then some of the worst points in the Fed scenario, which just FYI is a 3-year look. So they actually give quarterly points that need to be modeled by banks over 3 years. And these are just some of those points. So what does this mean to us? So why do we care? So some of these metrics, as you'll see, are already materially worse than what is considered a severely adverse scenario by the Fed. So, you know, one in particular that might jump out here is equity volatility. Now, again, equity volatility in and of itself doesn't have an impact directly on a balance sheet, but for an insurer that's doing a lot of hedging, equity hedging, this could impact perhaps significantly their hedging costs. And there may be other items on this list that impact insurers, like the way they price for products that are priced based on new money, interest rates, and spreads. You know, we see that spreads are very volatile. We see that interest rates are very low, and that occurred even before a lot of the adverse COVID impacts. And this might also be a sign of defaults that are yet to come. So again, the important point here is to ask companies that you're regulating how they're impacted, what they're projecting to happen. And some of these metrics we certainly expect to worsen. These are the most available metrics we could see at this point in time. But for example, unemployment, I think it's pretty clear that we're going to see higher rates of unemployment. So again, just making sure that the companies that we're regulating are looking at these metrics and considering the change in the environment in their strategy and their stress testing and their capital analysis. So with that, we can move on to the next slide. And I think perhaps we're ahead by one, Jennifer? Yeah, thank you. So this slide kind of gives a little bit more detail on some of the key risks that we might see by type of insurer. And I'll quickly touch on this for life insurers, and I'll get into more detail later. And then I'll turn it over to my colleagues to cover the health and P&C industries. So on the life insurance side, with a pandemic, one of the first things we think of is the increase in death claims. And of course, we will see that. I will say, I'll give you a little precursor to some of my following slides. This is probably not the biggest worry. It's certainly a worry, but probably not the biggest one for most life insurers. But we will see higher death claims, and that will be more significant for companies that maybe have an older mix of business or have substandard business, simplified underwriting. Companies may, point to offsets with annuities, and that's true. But of course, we have to consider the fact that, the deaths occurring now result in cash out the door now. Fewer annuity payments in the future aren't going to help a lot in terms of paying claims today. And then other things on this list that are important, we talked about the market environment, the investment portfolio losses, things we may see in certain types of investments like real estate, alternatives, energy, future counterparty default risk. And those things then in turn may impact the extent to which the company stays protected through their ALM strategy, through their hedging strategy. I do know at times when rates go really low, for example, life insurance companies may kind of ease up on their hedging and ALM because they feel like rates are so low that, they're bound to come back up. So just asking good questions about how those things are being managed in this tough environment. I do think liquidity, which is listed here, is a relatively more significant short-term risk. A lot of things will be changing in the environment in terms of potential for delays in premiums being paid for existing customers, slowdown in premiums from new customers, potentially institutional cash demands, so loans on products like bank-owned life insurance or corporate-owned life insurance. And so the combination of higher cash demands and potentially a lower ability to access liquidity in the market or liquidate assets because of the market might create short-term liquidity issues. So definitely something to keep an eye on. And then, of course, across all industries, we have a whole suite of operational risks that will impact, related to remote work, business continuity, so additional things to consider. So with that, I'll turn it over now to Becky to talk about the health insurance implications.
Thank you, Tricia. Yes, I think from the health insurer side, we're really focused on what are the direct and the indirect costs, not just of treating COVID, but also testing. That's grown to be quite a big bucket of spend. So one of the key risks for health insurers is really being able to estimate these claim expenses. Generally, health insurers might look to their claims data to determine how much exposure they have to a certain illness or condition, but if the claims data isn't in yet, they're kind of left without anything to measure. They can look to population data, but they have to keep in mind how much it will vary by geography, by the market, and even by what industries they're covering. They can see a very different result. So there'll be a lot of assumptions going into their claim estimates, and they'll have, more challenges than usual in estimating the claim balances. Another item related to the claim expenses is some of these COVID costs will not necessarily fall to the health insurer if they're covered by federal or state programs in some other way. So I think it's just something to keep in mind who will ultimately be paying for some of these expenses. And when it's time to set reserves, it's very difficult when you don't have a good history to look at. So they don't know what the ultimate claim costs will be in these most recent months. So again, just more assumptions and uncertainty going into their estimates for the claim expense. And that segues nicely into the next risk, which is related to kind of the case mix of services. So what we're seeing is this big increase in inpatient admissions and the severity of the inpatient admissions, which is somewhat offset by these almost elimination of some elective procedures and big reductions in anything that's not COVID related, only sort of emergency services being treated at this point. We also see an increase in testing for COVID and an increase in telehealth. So all of these drivers kind of moving in different directions have an impact on that mix of claims, which ultimately impacts the average cost. So again, that's something that needs to be monitored. Okay, moving away from claims and thinking a little bit about revenue, one of the biggest sources of revenue is the premium that's being collected from customers for health insurers. So on that side, as their customers are facing this economic downturn, that's going to have an impact on their ability to pay premium. In some instances, health insurers might be required to offer a grace period, or they may need to think of other considerations that maybe weren't thought about when the contract was originally made, but to help their customers get through this period when they may not be able to pay premium. So a lot of considerations need to go into that. And then not just thinking about revenue from the health insurer perspective, but I think it's also important to think about it from the provider side, because most, if not all, health insurers have some amount of risk sharing going on with their providers. So to the extent their providers are facing financial difficulty from not being able to do the procedures they normally would, that may put pressure on that relationship. And I think health insurers are going to think differently if they need to maybe give some bonus payments early or, reflect things a little differently during this time period, and how does that impact their overall results. Another risk related to the provider side is really access to care, and we've seen quite a bit of provider disruption. I think it comes from several different categories. First, providers are on the front lines, and they are at risk for contracting this illness, and if that happens, then they're not able to serve members. So that's one component. Also, providers are being shifted from maybe what they traditionally used to work on. They're being called in to help with either testing or treating of COVID. So that kind of eliminates resources for taking care of other illnesses or conditions. And then many providers have moved to telehealth. So that still allows access for members, but it's just a different type. They may not be able to get the same service that they had before. And I think this could really have an impact on maybe the chronic illness population, so people who are used to, some very specific procedures, now that's changed, and are they able to get what they need during this time period? Do they forego services because they're afraid of getting ill, and does that have a more long-term impact on their health? And then any other acute illnesses not related to COVID, how are those treated? Is everything taken care of properly? Are people able to get the care they need? And then the last risk we wanted to highlight for health insurance is related to risk adjustment. So risk adjustment is completely dependent on the claims data going into the models. So if claims are disrupted, that also impacts risk adjustment. I think we need to be aware of that. Health insurers need to be sure that they code telehealth correctly. It can be counted for risk adjustment, but it needs to be input correctly. So they need to make sure their systems are doing that properly. And then they need to think about the fact that there might be some catch-up at the end of the year for any codes and diagnoses that weren't collected during this pandemic period. We want to make sure they're all entered by the end of the year, so there may be some catch-up period. And then lastly, on risk adjustment, I just wanted to comment, the shift there. We expect there will be a shift in enrollment as potentially small group employers go out of business, or even larger employers have layoffs. You start to have this population that is looking for coverage elsewhere, and where do they go? If they go to the individual market, it changes that the enrollment mix for the individual market, and these members may not have had claims for a full year. They're joining, in the third or fourth quarter. So that impacts what the risk adjustment payout will be for those who are collected. So I think that's just another consideration on the risk adjustment side. So with that, I'll pass it over to Dave to talk about some of the P&C specific risks.
Okay, thanks a lot, Becky. And I just want to repeat what we said at the beginning here. We have a great audience for this webinar, and we really, really appreciate that you're taking time out from your schedules to listen to this. It is greatly appreciated. So on the P&C side, what I'll say at the outset is that the themes that I'll talk about here are similar and arguably identical to the themes that Tricia and Becky were just talking about on the life and health side. And that's one of the interesting things about this pandemic is how it crosses over all practice areas with those similar themes. Of course, on the P&C side, they each have their own twist. So we start off with claims, and just like health, there are potentially significant impacts of COVID-19 on claims that are hitting and will hit the P&C industry. So we list a few here, certainly not all, but business interruption, we felt appropriate to start there just because it's been so much in the news. And it's a line of business that doesn't necessarily get a whole lot of attention during ordinary times. That's obviously not what we're in right now. And it's vaulted to the spotlight recently as letters were coming out from Congress saying, about this business interruption insurance, doesn't that seem like a good source of funding maybe for all these businesses that are struggling right now? And it's easy to understand the logic behind that, but it's also easy to understand the insurance industry's position that if you start retroactively fitting coverage that wasn't intended, that could have quite the impact. And so you're hearing about that still virtually every day. People are talking about it on earnings calls. There are interviews out there. Business interruption remains a hot topic. Another hot topic on the P&C side is workers' compensation. And, many facets of the workers' comp system will be impacted by this, is being impacted by this, but presumptive benefits is where I'm going to focus for this discussion. So presumptive benefits, this is the idea, something that Becky actually just touched on towards the end of her piece, where you have all these frontline responders who are trying to take care of people. They are exposing themselves to potentially contracting the virus. And if they do, many states are saying, look, if you're out there and you're putting yourself in harm's way, you've got yourself a workers' comp claim. You do not have the same burden of proof that you might otherwise have to show that an injury was caused by the job. And again, this is something you can clearly understand why it's there. but it's also something that, creates, it has lots of implications for the workers' compensation system. And many of you may have seen the report that came out. I first saw it yesterday from the WCIRB, which looked at just potential impacts of a presumption of that nature being enacted in the state of California. That cost estimate had quite the wide range to it, but the low end was still in the billions. And that's just one state, so it's a big one, but, just the thing to keep in mind is that this is an issue that can impact the workers' comp system in a big way. The other one we mentioned here is medical professional liability. So, I think of all the healthcare facilities out there that had to really change the way they do business on the fly just so that they could treat people who were coming in with COVID-19 and all the downstream impacts on normal operations. So, you think about people who aren't getting their normal treatment because hospitals had to devote most of their resources to COVID-19 as an example. You think about the people who were getting treated for COVID-19, and you think about what happens in the aftermath of all this if lots and lots and lots of lawsuits come out related to medical malpractice. Is that fair? So, there have been legislative actions to provide immunity from claims under particular circumstances, but I just have to wonder with so many people impacted by this, with so many facilities exposed to it, it just seems like it's not an issue that's just going to go quietly away. I think we're going to be hearing about this for quite a while, and there will have to be some tough decisions on how to handle it. So those are coverages where we could see a lot more claim activity. It's hard to think of a P&C line of business that won't be affected in some way. One line that's been impacted arguably in the other direction is personal auto. That's not a surprise, I know, to all of you listening, and you're seeing the big auto insurers handing out, refunds or cutting premiums and so forth. That's what happens when nobody's driving. Frequency tends to go down. So I guess we'll just make the point that on the claim side, it's not a complete one-way story. There are things that are going up and things that are going down. So now I'm going to move away from claims and to the revenue side. And another major risk to P&C insurers is the potential drop in premium revenue that they are going to see. And that's what comes along when the economy slows down. Lots of major P&C lines of business have premium that is a direct function of how much payroll their insureds have or how much revenue their insureds are generating. So when that goes down, so does the premium. It's going to be real tough for insurers, for P&C insurers in general, to meet their revenue targets in 2020. And you just sort of imagine the planning process that the insurers went through before 2020 started, and how many of them may need to just essentially rip it up and go back to the drawing board. I would think many. I'm going to go from there to rate making and reserving data. So this is an area that is going to be interesting. The first and second quarters of 2020, to put it mildly, they're going to show some strange results when you think about frequency and severity. So now, put yourself in the actuary's shoes. That's pretty easy for me. But, if you're sitting here trying to help your company estimate what they need in the way of rates, what they need to set aside in the way of reserves, what do you do with that data? There are really no easy answers to that question. But I think we can pretty well conclusively say that when you just think about the risk that goes with estimates of rates and reserves, that risk is elevated. There's no doubt about it because of such strange activity that we are now seeing as a result of virtual nationwide quarantine. Let's go from there to liquidity. So liquidity and P&C, they do not necessarily go together in everyone's minds hand in hand, but we are trying to change that, and this is one place where that could, not for a great reason, but it could help do that. COVID-19 has introduced liquidity risk for P&C insurers, and that for at least one reason. And that's the point we made earlier about lower premiums. So you're an insurer, you expect to take in a certain amount of cash based on your revenue projections. When that revenue is not there, the cash isn't there. And I think we will see some issues with P&C insurers being able to meet their liquidity requirements, or at least having it stressed in a pretty serious way. So that's definitely something to keep an eye on for everyone out there. And the last point I'll mention here is on the investment side. So that could be an issue for P&C, just like it could be an issue for life. Tricia was talking about the market volatility that's out there. That impacts P&C insurers. When you look at the aggregate investment portfolio of the P&C insurance industry, equities are not that small a component of that overall portfolio. And so all the volatility that's out there, all the bizarre things we're seeing in the capital markets, oil prices, et cetera, that can impact P&C insurers. So that wraps up our discussion of the key P&C risks. And with that, I'm going to turn it back to Tricia.
Great, thanks, Dave. And you can move to the next slide, Jennifer. So although I already mentioned that perhaps mortality is not the most significant concern here, it is a pandemic that we're talking about, and your presenters do happen to be actuaries. So we did want to touch on this risk and maybe also give some, kind of supporting rationale for why this might not be the most significant worry. The next couple slides come primarily from data that the Society of Actuaries publishes regularly. So they've got a report on their website, so this is available for anyone to see, that is continuously updated to show some mortality information related to COVID-19 as the data emerges. So this slide here shows the case fatality rate. So that is the deaths that we've seen divided by the reported cases, right? So it doesn't tell us anything about how mortality will be impacted for the population or for the insured population. It just tells us death rates for people that have reported that they have COVID. So we need to do more than this. I mean, this is interesting information, and as I think most of us know, it's the older ages that are more significantly impacted, but we need to do more to understand mortality risk for a life insurance company. So you can move on to the next slide. So this next slide here gives information about the case fatality rate for some historical data points. So again, a lot of this comes from the SOA. We did supplement that to some degree. And so you can see here that the estimated case fatality rate, and again, all this is based on reported data, so we know it's incomplete, but the case fatality rate so far is 6.4%, and then we're comparing that to some other pandemic events that have occurred in the past. And some of those obviously having a worse case fatality rate, but having spread less significantly across the population. And so I used this information to try to say, what might some potential population events be? So having done a lot of work myself in ERM, I have seen many organizations look to the 1918 flu as a benchmark for a severe mortality event. And depending on even how you use that data, the range of what that translates into for a mortality rate varies a lot. But one benchmark is that resulted in about 6 deaths per 1,000. So that sometimes is used as an extreme event in mortality risk analysis. So again, these statistics are interesting, but the goal here is to try to get a little bit further in terms of what does this mean for population mortality or insured mortality. So then taking that data and going to the next slide, and I'm going to start on this next slide by saying this is not a prediction. So we've labeled it illustrative. Data is emerging. We do not know what is going to happen, what the ultimate mortality is going to be. The industry doesn't know. But what we want to do is do what we can, right? Like look at some metrics, try to be prepared, continue to monitor, make changes as we learn more. And so what we've done here is we've taken data about the industry statistics, face amount, RBC ratio, and then said, if we had 6 deaths per 1,000, what might that look like? So again, just one scenario. We do have to assume something about the amount of money insurers have already set aside to cover these claims, right? I mean, obviously they have reserves that they've been setting up. So we made a simple assumption here to say, on average, if the reserves cover 70% of the death benefit, because again, a lot of the deaths are going to be at older ages. So what we see here is that if we had 6 deaths per 1,000 and 70% of the death benefit was covered by a reserve, the deaths could cost the life insurance industry $117 billion. And the resulting impact on the RBC ratio associated with that would be a drop to 388% after considering the reserve impact. And then we also ran kind of a low estimate if it were more like 1 death per 1,000. And you can see the numbers that result at that side of the spectrum. And again, we're not even saying that's the range. We don't know, but it's just interesting to see what could happen. And it's going to be very sensitive to a lot of things, differences in health status, age mix, underwriting conditions. If you're loaded up with mortality risk, you're a reinsurer, maybe you have more. You use simplified underwriting or a lot of accelerated underwriting where you don't get medical information. Maybe you have more impact. There's a whole host of things that are going to impact the individual insurer. So all of those are important to consider. And again, there's a liquidity consideration here. If you're paying a lot of death claims, you have a bunch of policy loans go out the door, you don't collect premium for a while, you may have an adverse liquidity situation. Okay, so moving on. I'll turn it back here to Becky to comment on the morbidity risk, and then we'll jump into the case studies.
Thank you. For the morbidity risk, we decided to focus on kind of the health insurance cost as a proxy for morbidity. You'll see there's a lot of different estimates out there, and they're all contingent on what assumptions are going into the different estimates, really related to the utilization and the costs of these different things. So we focused on an article that came from the New York Times, which really referenced quite a bit from a covered California study that was pretty thorough, and we thought it was a good reference point. So there's a lot of uncertainty in these estimates, and we're just kind of giving this as a point in time to kind of level set what it could potentially be. The Covered California study looked at the commercial market, so they focused on 170 million members, not Medicare and Medicaid, so not those government programs. And their estimate was that costs could increase between 34 to 251 million. So I think that really highlights kind of the uncertainty and the range of what the possible impact could be. On the very highest end, they said it could be a 20% increase to the current spend, which would be $1.2 trillion. So there's a lot of unknowns going into these. One of the biggest assumptions that needs to be made is what is the cost of these inpatient admissions? Some had initially said, maybe we can use pneumonia as a proxy because we don't know what the ultimate cost will be for these cases. But we're seeing that some of the most severe coronavirus cases are much higher than that, as much as 3.5 times higher than a typical pneumonia case on average. And that's really driven by this extended ventilator usage. So this disease may be playing out differently than what we initially thought, and I'm sure our view will continue to change over time as we get more information. But that's just, sort of to highlight the impact of these assumptions and the potential range that we could see on the healthcare costs. So with that, I think we can begin our case studies.
Thank you. So I'll start with a case study for a life insurer, and in this instance, we're trying to, evaluate these risks through the analysis process. So in my case study, I have a life insurer that's got a mix of life and annuity business and some long-term care and disability. They primarily use a single A-rated global reinsurer to reinsure some of their mortality risk. Their asset portfolio is kind of a typical mix. So, corporate bonds, mortgages, structured. They do have some equities, but not a lot. And in this case, the company does hedge both rate risk and they've got some equity risk in their portfolio. The RBC ratio is 500%. They're holding some additional asset adequacy reserves on the long-term care block, which is not uncommon in this environment. They historically have really not had people work remotely. And then they have provided an ORSA report. The most recent one identifies some of their top risks as extended low rates, policyholder behavior, cyber risk, and key person risk. So they've got some talent that is key to the organization that if they lost, they would have some issues. So moving on to the next slide here, just knowing this as some of my background information, we put together kind of a heat map of what some of the things we might want to think about for this insurer, and just pausing here for the slide to turn for our heat map. So things that we would view as a relatively higher risk for this entity. So you can see here on the slide in the red. So of course, market risk. We know they've got some equities, they've got assets that are exposed to default risk. So I would definitely put that on the higher risk list. Key person risk could be magnified. I mean, in some ways you might find, less movement of personnel because of what's going on. But if they've got a key person that gets sick, that could be challenging. If there's issues with them doing their job remotely. Cyber, again, they're not used to being remote. It was already a high risk. So what are they doing? Asking them questions about what they're doing. And again, I've talked about liquidity a lot. I think this profile is right in line with my prior comments. I've also included on this slide some of the risks that may not be as critical, but certainly things to understand. And then in the middle, I think it's very hard to tell because we need just more details on what type of behavior they've seen from their policyholders before, but that could be a high risk. So, do they expect people to, leave them with high institutional demands, magnifying liquidity? Do they expect a bunch of policyholders to stick around and they have high interest rate guarantees in this low interest rate environment? So this kind of just summarizes where I would place the risks, again, based on a very high level set of circumstances. And I do want to make sure we have time for all our case studies. So we're going to keep moving here. And so the last slide on the life case study is just, what do I do? So I've got this information. I'm aware of some of the risks. What do I want to do? So we've listed on these slides, like, here's some things at a minimum I would expect this company to be giving me, right? They should be disclosing expected impacts around COVID. They should have a plan in place to respond to their customers. Even though they have some operational issues, like, they should be on top of what their customers need, and they should be able to answer basic questions about how this impacts their solvency, liquidity, operations. Things I might want to ask for are business plan projections that reflect these scenarios. I do see we got a question related to long-term care, and I'm not going to go too crazy. We can talk more in the Q&A, but they have a long-term care block. Of course, you sort of immediately think to, well, this is a mortality event, long-term care, the tail risk when people are in a nursing home for a long, long time is what I'm worried about. And so maybe this is a good guy. And I don't disagree with that. But that said, the reason I say here, ask about plans for reserve strengthening is, this is going to emerge over time. And there are other things to think about. Rates are very, very low. They're lower than they were at year end. And long-term care may be backed more by structured securities and equity to try to boost yield, which are not going to do well in this environment. And then lastly, the fact that, family is restricted from visiting people in nursing homes, or there may be more challenges in getting the care that they need. For those that don't get infected, we may see increases in morbidity. So anyway, I think understanding the facts and circumstances is important. And, based on those, especially in the short term, might they need to strengthen reserves? Maybe they've done some interim stress testing, ERM analysis. They should have regular ALM and hedging reports that show what happened in March, what happened last week, hopefully. I would want to see liquidity analysis. So what do they have for liquid assets? Have they been able to tap into contingent funding? Can they get money from their parent? Life insurers sometimes are accessing funds from the Federal Home Loan Bank. Do they have contingent liquidity available? And then what do stress demands look like? Do they expect to see an uptick in claims or loans? Are they expecting a decline in premium? So they should be able to show over a week, 2 weeks, a month, 3 months, 6 months, that type of analysis in terms of their stress liquidity. And then what are they doing about it? So then what do I do? If I'm looking at all this data, what do I do? So things I'd want to evaluate, what are they assuming? We learned a lot in these pages, and I'm sure everyone on the phone has a lot of statistics at their disposal in terms of the marketplace. How do those assumptions look relative to what we see? Are they aggressive? Are they assuming a fast recovery? Are they assuming interest rates go back up quickly, that equities stabilize? So I would want to look at what they're assuming in those projections and stress tests. And if they look poor, are they already taking action? Have they looked at backup liquidity sources? Have they made changes to their hedging? Are they changing their products? And then, in the big picture, we want to consider this over the long term, right? Again, just because we have a bad metric in the equity market on one day, most insurers can probably withstand that. But if we have extended low rates for a long period of time, can they continue to withstand that? So just looking at this from a longer term perspective. And then let's say I get that data and I'm not happy. It looks like I have a serious issue here. Other things I might want to do with the company, maybe it warrants a targeted review with, management letter comments coming out of that. Maybe I want them to provide me a regular report every month based on something I see to make sure that they're addressing it appropriately. And, in extreme cases, maybe we might get to the point where, there needs to be RBC corrective action plans, curtailment of sales. So just some things to think about. And there's many, many more. We only have our hour today, so I'll stop there. But we do hope to have a little time at the end for Q&A as well. So with that, I will turn it over to Becky to cover a case study on health insurer rating.
Thank you. Yeah, so for the health insurer case study, we wanted to focus more on a rate filing so that we can think a little bit about premium setting and what concerns might go into that and rate review. So our example is a pretty simplified health insurer here. They offer individual and small group. There are a few other carriers in the state, and they've had basically a stable market in terms of their plans and their enrollment and things like that. So really nothing of note on this page. And all things equal, we would probably expect to see a premium increase around trend with no other changes. We can move to the next slide. But of course, all things are not equal, and there will be some extra scrutiny, I think, during the rate review for 2021 premium rate setting. What we list on the left side is kind of the minimum expectations. These are the things that would be reviewed on any rate filing. We want to make sure that the assumptions are supported by the data and that we can they translate through to the premium rate increase and compliance with minimum loss ratio standards and all those things, just normal course of business. But some things we wanted to highlight that might be, a little different now that we've gone through or in the midst of this pandemic. On their trend assumption, does the health insurer expect that there will be a second wave of COVID? And if so, when will that hit? How big will it be? Who is impacted by it? And another big trend component, I think, will be what happens with these services that were delayed during this time period. Are they all caught up by the end of 2020? Do some roll into 2021? Do some never return? I think it's just going to be a big assumption, and we want to make sure that it's clearly documented in the rate filing. You can go back to the next slide, please. On the risk adjustment, I think the CMS has acknowledged, there's some procedural issues and there's some delays and things. So CMS pushed back the 2019 risk adjustment data collection and the reporting by about 2 weeks. So now it's available July 16th. That might put pressure on some of the timeline for the annual rate review. They haven't moved back to the HIOS filing deadline, so just something to keep in mind. There may be a little tighter window there. But that being said, the 2019 risk adjustment will not necessarily be that helpful in predicting what the 2021 risk adjustment will be. So I think just making sure it's clearly documented what assumptions are going into that 2021 projection. It's always important, but I think it's going to be more important this year. In terms of the risk pool, as we mentioned earlier, there may be shifts in enrollment caused by layoffs or unemployment where now people need to look for coverage in different places, and that can result in your risk pool makeup being different than it was last year or this year. So I think it's something important to think about. When we go to set premiums for 2021 or annual premiums, we will not have complete data. We will not know probably the conclusion to all of this. So we need to make assumptions about how much shift there will be, where people will go, and what will the people who move, what do they look like? Do they look like our standard individual market, or are they different? So I think there's going to be a lot of assumptions going into that. And again, we need to make sure they're documented so we can understand what they are. There's the potential that Congress takes some sort of action, either a reinsurance program or other aid. If that does occur, we want to make sure that it's properly included in the rate development and that it is reflected. Or if it doesn't happen, the same thing. We want to make sure it's not reflected. On the reserve side, we just note here that, while normally losses from this year shouldn't impact the next year's premiums, to the extent that insurers have to use up a lot of their reserve to pay for claims now, it may be appropriate that they're building something in to build up their reserves to some extent. So it's just something that may require extra scrutiny when you're going through the rate review process. What I personally think will be the biggest and most difficult assumption will be the morbidity. It's normally a difficult thing to measure. We don't have a perfect prediction of morbidity, unfortunately. So what makes it harder now? I think, one, COVID is new. We don't know what it's going to look like in risk adjustment. We don't necessarily know long-term impacts. We don't know, if people are reinfected or different things like that it's still sort of evolving. We also don't know the impacts of just a pandemic on our covered population. I mean, there are a lot of ripple effects from this. It's changed the way of life for almost everyone, and I think that may have some very indirect impacts and also just clearly direct impacts. Staying at home is a big lifestyle change, and so you may see that there have been, differences in contracting other illnesses or other morbidity factors there. So, again, I think from the assumption setting, we need to think about, okay, what does it look like during the pandemic, and then what carries forward, and how does it look in the future? So it's kind of these two different measures, and documenting what you assume in both periods is going to be very important for understanding the premium increase. In addition to the impact to small groups and others, there may also be an impact to health insurers. We may see that some carriers leave the market after this event if they're not able to withstand these claim levels. And if that happens, that also creates some shift in morbidity for your covered population if you remain. So I think we need to kind of consider all these moving parts on the morbidity assumption and make sure we understand what the health insurer is thinking when they set their morbidity, and that it's in compliance with all of the federal and state regulations as well. And then lastly, we just also wanted to comment that there could potentially be permanent network changes. There may be temporary network changes now as things have shifted and care is kind of moving all over the place. But there could be a long-term impact where some providers either go out of business or change their business model in other ways. So there is potential for network changes. In addition, as I mentioned earlier, I think it's important to think of the risk-sharing arrangements that an insurer might have in place with the providers. Those may need to morph over time, or they may just simply need to account for the fact that you have this very unique period in the experience, and accounting for that properly and making sure that all the measures are correct. And then lastly, the impact of telehealth is unknown what it will be long term. We know what's happening right now. Will it stick? Will we still see a lot of telehealth utilization when the pandemic ends? Will more providers want to be able to do telehealth? Will we need to revisit fee schedules to make sure that they account for telehealth properly? So I think it's just that may have a lasting impact, or it may not, but it's something that should be considered for going forward in 2021. I think these rate filings will start to come in the summer for the annual filings, and we may have just recently had third quarter filings in the last month or so, and potentially could have fourth quarter filings coming in a month or so. So definitely something to be aware of, and hopefully these are some areas that could be, require a little extra scrutiny, and I would say the most important thing is having just good documentation so you clearly can see what the assumptions are. With that, we can move on to the next case study.
All right. Thanks, Becky. So we're going to wrap up with this hypothetical P&C case study. So just imagining a risk-focused examination. We've got an insurer who focuses on commercial lines. They write some catastrophe-exposed business. They're diversified. They've got casualty business as well. They have an agency force that is sourcing the business for them. And they try to lay off some of their risk by ceding to reinsurers, both domiciled in the U.S. and domiciled in other jurisdictions. And we've got an RBC ratio that I think of as decent, not great, decent, 400%. So let's go to the next slide now that we've set the table. Okay. So, what I'd be thinking about, sitting in the shoes of an analyst or an exam manager, or really anyone involved in reviews of these companies right now, I'd be looking for what kind of disclosures are being made in the financial filings, first quarter, anything after first quarter, what are companies saying about subsequent events? What are they saying about events that are impacting the balance sheet and financials right there and then? This is all good information to know. And then going back to the agents in this particular, again, hypothetical case study, agents typically make their money by producing business, and when the source of business dries up, for some of the reasons we were talking about earlier, like economic slowdown and so forth, you worry. You worry about what the agents are going to, put on the books. Will they maintain their standards? It can be hard. It can be hard to do that, again, when the business dries up. So what kind of controls are in place to make sure that the quality of the business is meeting the needs of the insurer? These are questions that I would be asking. And, you also have reinsurers in play here, and this is a real issue and a real concern. Thinking about the ability of reinsurance companies to meet their obligations to the ceding insurance company. Paid loss recoverables could be stressed right now. Outstanding reinsurance recoverables could be stressed right now. It's hard to know, and it's potentially especially hard to know when you have offshore reinsurers that may or may not have the same degree of financial reporting requirements that we have in the U.S. So keeping a close eye on the creditworthiness of the reinsurers, that's that's here and now. That's something that we all have to keep an eye on. And then when you roll it all up, the question is, how are you looking? You remember we had a 400% RBC ratio going into things. In this particular case, I would be saying, what's that RBC ratio looking like now? And of course, you have to really hedge the answer. I mean, there's so much uncertainty right now, but still, it would be good to see insurers putting together the best analysis they can to forecast what that RBC ratio and solvency in general might look like, not to mention liquidity, which we talked about earlier. So some of the things that could be requested, I mentioned business plans. I think a lot of them will be ripped up, redone. So getting those revised business plan projections, definitely something you'd want to see. You'd want to see stress testing. Stress testing, when I think about the stress testing that I've witnessed, really looking at ORSAs and so forth, there's a lot of depth to it. There's a lot of really good things that go in it, but I also think we're limited by what we've experienced in the past. So before 2020, I didn't see a lot of stress tests that entailed, major impacts happening simultaneously to assets, underwriting results, and operations, with everybody having to change on the fly how they do business. You just didn't see it, and it's not surprising because it really hadn't happened before. Now it's happened, and you'll probably see a lot of stress testing that folds in those types of impacts, but you also have to ask yourself down the road, what does the next one look like, and how do we think about stress testing going forward? But I'm starting to stray from where we are here, which is just, it's a good idea to ask the company what they're doing for stress testing now in light of the information we all have. And, a couple more points back to the data. Becky just mentioned this herself. The data and how it's interpreted, how it factors into projections, both for rates and reserves, that's a big deal. The independent agents in this case are really anyone who's sourcing business, whether it's, it's underwriters, it's everyone. How are they maintaining the quality of the business, even as there's real downward pressure on the amount of business available to write? And finally, keeping an eye on those reinsurers. That's something that will be a big deal and impact many P&C insurers and really across the insurance industry. Something we have to watch. So with that, we are finished with our presentation. We thought we'd end with a quote that, regardless of your political persuasion, you might find is pretty applicable right here, from Mr. Rumsfeld. And with that, I am going to hand it back to Tricia, and we'll have some time for Q&A.
Thanks, Dave. So I did get a question about how to get a copy of the slides, so I'm going to cover that first because at some point we might start losing people. So if you would like to receive a copy of the slides, you can email reply RRC, so that's REPLY RRC at riskreg.com. So again, it's reply RRC at riskreg.com, and a copy will be sent to you. And thanks for asking. We appreciate your interest. So I will now go to, I see we have some questions in the chat box. So for folks that might have a question and haven't asked yet, what you can do on the webinar is just enter a chat into the chat box that's on the right-hand side of the screen, and that will pop up. We can see it, and I'll read the questions and then direct them to someone to respond to. So the first one I will ask here is for you, Becky. So the question is, do you think political pressure will lessen the ability of health insurers to increase rates significantly to a rate that would maintain solvency?
So this is a great question. I don't know if I would call it the political pressure per se, but I do think that regulators have a tough situation. They need to balance protecting the consumer, but then also managing, worrying about solvency for the insurer. So what I think will happen is there'll be some, maybe friendly conversations at first between insurers and regulators to kind of determine if rate increases can be put off or filings can be delayed in any way. I think that is unlikely to happen, and what is most likely to happen is that rate increases will be getting a lot of scrutiny. To the extent that the assumptions are justified and sound, I think they will be approved. They will need to be approved. But I know the health insurance industry is very active, and they're kind of making their opinion known, communicating with CMS, communicating with others to get their viewpoints out there. So I don't think that anything will happen, to have a negative impact on solvency per se. I think that if it's justified, it will be approved in the end, but there will be a much more scrutiny on any rate increases.
Yeah, thanks, Becky, and justifiably so, right? Again, we're in a situation where it's very hard to set those assumptions, so critically important to be looking at them very, very closely. So great comments. I will cover one more. So we did also get a question about specific risk for reinsurers, and we did touch on that throughout our slides, but I'll just add an additional comment because in the interest of making sure we got to the Q&A, I did personally skim over the this item in the case study. So this would apply in general, but the life case study you might have noticed highlighted a situation where there's reinsurer concentration. So if you're regulating an entity that has concentration with one reinsurer, or of course if you're looking at a reinsurer directly, it's going to depend on their mix of business. But if there's a very significant amount of mortality risk, mortality risk business versus financial reinsurance, and it tends to be centered in those higher risk areas like older ages or substandard risks, then I do think the risk is significantly magnified. And again, as much as maybe mortality isn't at the top of the list across the board for that entity, it might be a very significant one. So making sure that they have analyzed that. How stressful have their stress tests been? And then the other thing to consider is if it's a direct writer ceding to a company offshore, I mean, what other countries do they have business from? What do their regulations look like? I mean, it becomes even more complicated to understand the default risk associated with that reinsurer. So I did want to add those comments. So I'll give it a second here to see if we have additional questions coming through the chat box. So I don't see any others. I think the others we addressed during the course of our presentation, but maybe I'll just ask my co-presenters if you may have seen something come through that I missed.
I did not.
Okay. So we're...
Tricia?
Oh, sorry, go ahead.
Tricia?
Yeah, go ahead.
Hey, we did one question from Karen Armstrong. Should we take into consideration the NAIC form questions before we ask a company?
Okay, yeah, great question. So as probably everyone is aware, there are a series of great questions that are contained in the NAIC template. that can be used to, to gather information from your companies. And so I would say a resounding yes, because a lot of the things that we talked about are in that template, right? I mean, it asks for information about impacts on claim frequency and severity and loss ratio and stress testing and operational impacts. So absolutely yes. And, and maybe it'll be there, right? Maybe you'll get everything that you need. But if not, then yeah, we've talked about some things that might warrant a follow-up. So yeah, great question. And I really appreciate it because it's an important thing to consider, and we did not mention it. So thank you so much for that question. Okay, so I do recognize here that we are approaching the top of the hour, and I do know that, again, people are really, really busy. So I just would say, again, thank you so much for participating. It's a very hot topic, and, covering as much as we can in an hour is sort of the best that we can do. And if there's a question that, maybe came through a little bit later and we were not able to answer it, my apologies. I mean, we tried to cover it all, but we also tried to stay on time here. So we did include on this last slide contact information for the three of us, and we would be happy to have a conversation or answer a question by email with anyone on the line anytime. So don't hesitate to use those contact email addresses. So thank you so much, and there's more to come. So we look forward to continued conversations on this topic.